Why would Warren Buffett, the Oracle of Omaha, dump over half of his cherished Apple stock?
So on Saturday, Buffett reported that his conglomerate has cut almost half of its position in Apple. That was during the second quarter.
This is the question on every investor's mind. In a move that has sent shockwaves through the financial world, Berkshire Hathaway, under Buffett's leadership, sold around 505 million shares of Apple, cutting its stake by over half. This drastic action has left many speculating about the reasons behind it. Is it a signal of impending doom for Apple, or is there a more strategic play at hand? To understand why Buffett made this move, we need to look at the background of his investment in Apple.
Billionaire investor Warren Buffett, apparently he still has faith. His company, Berkshire Hathaway, recently purchased more than $1 billion of Apple stock. Buffett usually avoids investing in tech companies, but one report indicates others at Berkshire Hathaway made that critical decision.
Berkshire Hathaway first started buying Apple shares in 2016 under the influence of Buffett's investing lieutenants, Ted Weschler and Todd Combs. Over the years, Buffett grew increasingly fond of Apple, calling it Berkshire's third business after its insurance operations and BNSF Railway. By the end of 2023, Berkshire's stake in Apple was valued at approximately $140 billion, making it the largest holding in its equity portfolio. The decision to start selling Apple shares began in the first quarter of 2024, when Berkshire trimmed its Apple stake by 13%. Buffett hinted at the Berkshire annual meeting in May that this was partly for tax reasons, as selling some shares now could be beneficial if capital gains taxes were to increase in the future. However, the magnitude of the selling in the second quarter suggests that there were additional factors at play. One of the primary reasons for the sale could be related to market valuation and portfolio management. Apple's shares had surged by 23% in the second quarter, reaching new record highs. Buffett, known for his value investing principles, might have deemed the stock overpriced and decided to lock in profits. Additionally, Berkshire's Apple holding had grown so large that it took up nearly half of its equity portfolio, which could have prompted Buffett to rebalance his investments to avoid overexposure to a single stock. Another significant factor could be economic concerns. Buffett has been known to amass cash reserves during uncertain times. By selling Apple shares, Berkshire raised its cash holdings to a record $277 billion by the end of the second quarter. This move could be a strategic play to prepare for potential economic downturns or to have liquidity available for future investment opportunities. Despite the massive sell-off, Buffett has not lost faith in Apple. At the Berkshire annual meeting, he reiterated his admiration for the company and its CEO, Tim Cook. The sale was not a reflection of any issues with Apple's fundamentals, but rather a strategic decision based on market conditions and tax considerations. Warren Buffett's decision to dump nearly half of Berkshire's Apple stock was driven by a combination of market valuation, portfolio management, and economic concerns. Buffett is positioning Berkshire to navigate potential economic uncertainties and seize future investment opportunities. This move underscores the importance of adaptability and strategic thinking in investing, even for seasoned investors like Buffett. Whether you're a seasoned investor or just starting, there's a valuable lesson to be learned from the Oracle of Omaha's latest move.